Thanks. My name's Sean O'Brien, and as always, I'm pleased to be joined by Steve Huntington. Steve, you want to go ahead and introduce yourself, and then I'll go ahead and introduce myself today.
Yeah. Thanks everyone for joining us for another installment of Coffee Talk. It's been a minute. It's 2026. It's already March. We haven't spoken to you guys, at least in this format, since just before the holidays. So hope everyone had a nice holiday season, and we are back at it for 2026. I'm Steve Huntington, the director of analytics here. And I've spent my entire career, 25 years plus now, I guess, working with community banks all over the country and everything from strategic planning and M&A and capital to analysis like you see here. And I've been working with Sean at the now newly combined companies for about half of that time.
Thanks, Steve. So I have a little bit different, oops, um, title. I had the wrong slide up there. Sorry about that. You can already tell I'm already uh, comfortable in this new role and uncomfortable in my old one. So my title here today says industry expert. For those of you who may or may not have known, I retired at the end of the year, but I'm back here to do the coffee talk today. And as you can see, I'm a bit rusty, but needless to say, certainly have been on these before, despite not acting like it today. But so a little bit different role for me today and going forward. Like I said, I retired in January, but hopefully we'll still come on here occasionally and be a guest panelist with Steve. So looking forward to that. Steve, I'll let you talk a little bit more about OptumFI and kind of what's happening here. I'll show the next slide, and you can share, and I'll share after that. Just kind of what's happened here in the last few months.
Yeah, so we have undertaken a rebranding exercise, is what we finished at the end, right around the end of or the beginning of 2026. A couple of years ago, we joined forces with a company called Infusion, and so we've been working. Quick Rate and Quick Analytics and IntelliCredit have been working with Infusion for a couple of years at this point, and so we decided we had a handful of different logos within our kind of group of sister companies, and we decided it was high time to go ahead and do that exercise of coming up with a new combined brand, which does a much better job of explaining and capturing, sort of encompassing all that we offer to our customers. And we just finished that process in the last few weeks here, and so now we are collectively known as OptumFI. We're still all the same people, all the same tools that you've come to know, and we look forward to offering a whole slew of additional ones as we go through 2026 and beyond. John?
Perfect. Yeah, Steve said, right, a big task, put it all together under a new brand. But as you can see, let's see, there we go. We have kind of divided it up into three different areas. Again, addressing the three most fundamental areas in banking, we think, and kind of think better aligns everything as the company moves forward. So you'll kind of see OptumIF growth, credit risk, and balance sheet. So as we move on to today, oops, again, similar format in the past. Certainly hope to share some information with you today. Certainly, if you have questions, you can go ahead and submit those, and we'll try to monitor them as best we can and take them either in an appropriate break in the conversation or at the end. As also, we're going to start with a few polling questions, and I think Jen's going to go ahead and launch those. And if Jen, if you want to go ahead and start that, let me see if I can.
Yep, so you should have the first
Yep,
poll up
perfect.
now.
Yep.
And I'll keep an eye and let you know when we're ending it.
Great, thank you. So, what do you expect to see in 2026 for past due loans as a percentage of total loans? So, a single choice between significant increase, modest increase, no change, modest decrease, significant decrease, and I expect zero past due loans. So,
Looks like modest increase is winning the race right now.
okay. And
Give
we'll
it
just
just
give
And you have one of
this.
those little graphics with the ducks going around the track and seeing which one's winning.
All right, we'll go ahead and end this, and I'm going to share results.
Yeah, perfect. So modest increase, 68%. That seems to me be in line. 22% no change, but that's that's probably what you'd expect. I know at our bank in Illinois, we've certainly seen a modest increase through the second half of last year, and kind of continued in here to the first part. So Jen, if you want to go ahead and stop sharing that and then launch the second one. There we go. Thank you. What do you expect to see in 2026 for reserves as a percentage of total loans? Again, significant increase, modest increase, no change, modest or significant decrease. Why do I need reserves when I have no foreseeable losses? Single choice on those again. And we'll just give this again 30 to 45 seconds.
Modest increase and no change is fighting it out. All right, we'll go ahead and end this one.
And again, as Jen said, modest increase and no change, 55% for a modest increase and no change at 42%. 3% of you do note a significant increase. So certainly something to watch as the year goes on. The third question is, has your institution performed any formal credit or capital stress testing? Again, a single choice. Yes, portfolio level, credit capital stress testing. Yes, loan level. Yes, both. No. And again, with no losses expected, what is there to stress?
Give this one just another couple
Sure.
seconds. All right.
Okay. And the results are in. 34% for both. So that's encouraging. Yes, for loan level credit stress testing, 19 for portfolio level. 18% of you haven't. And then again, with no losses, that's good. 3%. What's the stress? I like it. Okay. How confident are you that current credit analysis process gives you timely, reliable visibility into your portfolio risk? So again, just a single choice here, and we'll give this 30 to 45 seconds as well.
Go ahead and end poll. And I'm going
Perfect.
to share this, and then we have one more.
Okay. 40. Okay. Kind of a nose to nose finish with very confident and somewhat confident. So that's great to see. 11% still relying on heavily manual processes, and 6% actually actively looking to improve this. So certainly something, if you want to have conversations with the OptimFI team, there's certainly things we think we can do to help. And then I guess this is the final question. Have you engaged any third-party vendors to assist in portfolio or credit analytics? Again, we'll just give this 30 to 45 seconds.
Yeah.
Okay. Thank you, Jen. 46 currently are engaged. 41% have always managed it with internal solutions. And finally, 14 no, but we have in the past. So again, thank you for participating in those. Those results, copy of the slide decks, and a link to the recording will, as customary, will be sent out to you in a follow-up email, likely Monday afternoon. Okay, so as we move forward here, let me get the slides rolling again. Again, I think one of the things that is never ending, even in conjunction with the rebranding, is there's continual updates and enhancements to CECL Solver. Steve has a few of them listed here, and we'll certainly talk about anything that's coming soon later in the discussion. But again, we're just constantly trying to stay in touch and evolve as the guidance and any new information helps us. So I think continued exciting things to come with CECL Solver. All right. So, as one of the things that Steve, we had included into the CECL solver was just some updated stress testing trends and projections that the Fed provides. Steve, incorporates those into CECL solver. Steve, you want to go ahead and talk about this in the next couple slides?
Yeah. Sorry, just give me one.
And while he's doing that, Sean, we did have a question about the pronunciation of Optima FI.
Yes, I think you just answered it,
I
but
did.
so I love it.
I'm gonna read you the question and tell the answer at the same time.
That's the best.
Yeah, so this is just something that we started pulling up and sharing as part of our knowledge base about I believe 2 years ago, and it's something the Fed updates once a year, and they do it in mid-February or so. And so I'm just letting everyone know that that data, which is rapidly becoming some of the most popular data that our users are using currently when it comes to justifying qualitative factor adjustments for external economic data. Certainly, we have economic data sets that that are in chart sort of format within the CECL solver, but these are the exact economic time series that the Federal Reserve uses when they're giving guidance to the largest banks in the country who still have to do um, those DFAST level stress tests. And what they did was they kind of came together with some of the best economists that they had and choose these 10 or 12 economic time series, and they have 20 years worth of quarterly data points going all the way back in time, and then a sort of the consensus actual estimates or projections for the next 3 years on a quarterly basis in a perfectly kind of apples to apples way, which is really nice. So you can see those long-term historical trends in a granular quarterly level, and then flip right over to 12 quarters worth of projections moving forward. In the baseline scenario is the actual projections from the economists. The severely adverse scenario are not projections at all. They're a hypothetical, severely adverse kind of worst case scenario for the economy. So they're not what anyone actually expects to happen, but they're the kind of highly ramped up, um, um, you know, uh, problematic economic trends that the Fed wanted to see the largest banks use in their severely adverse scenario. So some very helpful data there that you can use when justifying qualitative factor adjustments for CECL. And also, if you're doing it in any sort of stress testing scenarios or analyses that you're doing, whether they're internal or via third party. So we update that in the middle or end of February every single year. And we just updated it recently. So I wanted to let everyone know that the 2026 through 2028 projections are all up there. By the way,
Great.
we have gotten some questions in the past as to why some of the historical data points there seem to keep bouncing all over the place. And we can't take the credit or the blame for that. As you know, there's always lots of revisions to those sort of economic trends, and those revisions happen uh, multiple times over a longer period of time moving forward than I would have assumed, actually. And so even 2 years from now, you might come back and see something that you had, if you'd taken this and exported it and done something else with it, and you're trying to match up, historical periods for the individual economic trends. Just know that we're updating even the historical ones as they get refined and revised retroactively over time.
And I would just add the one thing I always found helpful about this, even if nothing else, even if you didn't incorporate it for any stress testing, but as Steve said, right, this is the Fed's baseline kind of economic forecast too, right? So I mean, amongst the daily noise of what's going on in the economy, I always found it helpful just to really see kind of what was the baseline kind of forecast, right? And so you can kind of look at all these numbers and see where GDP growth, and how fast the economy is going to grow, and 2% is kind of the number for the next couple of years. On a real basis, you can see the inflation rate expected to slowly, come down over the next couple of years. Treasury rates, and then, you go down to the bottom, you see mortgage rates and prime rate, right? The mortgage rate, right? Not much of a move expected over the next couple of years as the base case. So again, I just think it's, if nothing else, it's good to just see kind of what the baseline expectations
Yeah,
are.
and as an analyst, or I read in parentheses nerd, looking at the data, one thing that frustrates me the most is I typically you typically see these economic things come in kind of in a vacuum, right? You get one piece of economic data that's for February of 2026. Then you get something in March that was for the whole year of 2025, and it's all apples to oranges to kumquats as far as from what period and over what period you're considering it. What's nice about these is they're in one spot and they're all as of the same date and they're all quarterly the same durations and periods going back in history. So it really gives you a very consistent baseline of economic data to use looking backwards and forwards.
And see, we did have a question come in. Is where again is this located on the site?
Yeah, so when you go to the CECL solver, you open up the CECL solver, there is a big blue button right up top that says CECL solver knowledge base. And when you click on the knowledge base, a new tab will open up in your browser with a handful of knowledge base type tools. And right in the middle of the bottom of that new tab, it'll say Fed economic stress testing trends and projections, or economic scenario indicators. So you can find it right there.
Perfect. All
And
right.
it'll open up its own new tab with what you see there, and you can choose between the historical data, the baseline projections, or the punitive scenario.
Perfect. So one of the things that Steve's been working on is just trying to refine and improve our industry research pages. So Steve, you want to talk about what you've done here?
Yeah, so wanted to revisit some things. We had a handful of enhancements that we were working on last year, and some of them took a little bit of a backseat from a timeline standpoint with our rebranding exercise and whatnot that we've been working on together. But since we got a new brand and it's a new year, I wanted to kind of spend some time today showing you guys a handful of enhancements that are coming during 2026. This one right here, you guys have never seen before. You might have seen something that looks like it in our old QCBI. So our old QCBI report, which stood for Quick Analytics Community Bank Index, is now we call it now the PPI, which stands for Peer Performance Index. Same concept. And in that QCBI report that we sent out, that has that kind of a state of the state for community banking in your neck of the woods or nationally, and there's a report that we sent out every quarter for every state. We had what we call the performance matrix was in that report, where it showed kind of the most important metrics, and then for your peer group or your state, it would kind of give you a spectrum of what the value is like for the worst performers all the way to what the values are like for the best performers in decile. So you can see, for example, for reserve levels, 77 basis points is the 10th percentile, all the way up to 1.82% is the 90th percentile of reserves for community banks all over the country. But it was very much a static sort of table that we added. And as you guys know, we spent a lot of time last year, had a big initiative to make a lot of our industry research kind of 2.0 it, so to speak, make it all much more interactive. And I previewed that in previous coffee talks. Right on the website there, on the main table of contents is a button called Industry Research. And if you go there, you can work on credit analysis, you can look at performance analysis, and you can choose any types of metrics that you want to see and chart them interactively with different peer groups and banks over time, look at different percentiles. But this is a newer addition that we will be adding in the next month or two here, where you can choose the metrics that you want. So you can create your own performance matrix, right? You can choose a bunch of credit quality metrics, or you can choose a handful of sort of summary or highlight metrics, and then choose what period you want. If you want to look at just kind of for an individual quarter or for all of last year, and then choose a peer group. It can be your UBPR peer group. It can be your, all the community banks in your state, or it can be a completely custom handpicked peer group by you. And then when you do that, it interactively builds this table here, this performance matrix, where you can get a feel for the good, the bad, and the ugly for those metrics for that peer group kind of in one interactive snapshot. I demo it online right now, but we got a lot we want to go through today. So I figured just a good descriptive screenshot will get the job done. This again, we expect to be live quite soon here. So I would expect within 1 to 2 months, this will be live on the website.
Great.
Now, this one is something that we started working on last year. We had a bunch of requests from institutions who were looking to just have more flexibility with the peer trends in CECL Solver, because many of you on the call, many community banks around the country, the vast majority of their reserve is coming from Q factors, right? Because when you look at your historical loss experience over the last few years, there's a whole heck of a lot of zeros in there, right? Many of you on the call probably have almost zero net charge-offs aggregate over the last 3 or 4 years in your entire portfolio. So, given that CECL requires that we kind of look to the past and then modify it for the future, if our past shows all zeros, a lot of us are in that boat of justifying almost our reserve almost entirely from Q factors. And one of the best ways to do that with apples to apples data is this public peer data tab that we shared, where we calculate not just your loss experience over the lifetime loss rates, lifetime going back in time, but doing it for each of the banks in your peer group and aggregating them together to get this. However, we found that, for some institutions that not only did they have no historical losses recently, but they may be in a market that where most of their peers have experienced very little, if any, losses on those segments over the recent past. And so at that, the problem there is that, again, the peer data is not really giving you much to go on as far as justifying Q factors. So we decided we wanted to give you guys some more flexibility there, meaning instead of just looking at weighted average historical loss rates for your peer group over time for each segment of the portfolio, we're going to allow you guys a percentile knob, so to speak. So you can pull up median values, which are going to be very close to zero, or you can dial it all the way up to 70th, 80th, or 90th percentile loss rates for your peer group, very much in the way that a stress test would do. Not coincidentally, the way our automated portfolio stress test has this exact feature in it, but our CECL tool never has. And so we're bringing that functionality over to the CECL side. So you'll be able to kind of make your peer historical trends more punitive, which will give you some more justification or data behind your Q factor adjustments for different segments of your portfolio where you've had very little losses, and maybe even your average or 50th percentile peer hasn't had much in the way of losses. Sean?
Yeah, I think this is something that Steve mentioned we've been working on for quite a while, and just felt like the stress test had some functionality that we thought, was really could be utilized effectively in the CECL solver. And so I think this is an exciting addition that's finally coming to fruition, because, again, I think, we are looking back and then looking forward, and this just gives you a whole lot more granular data that you can look at for historical charge-offs from peers at a more refined level that I think, again, and from the previous page, right, you could see like where the 10th percentile was already starting to see much more impactful numbers on losses and things and past dues. This same kind of way can lead you to maybe start moving your Q factors in advance of charge-offs, maybe at your own institution, as CECL is supposed to do. Again, it's something we've done at our bank in Illinois. We've seen, our past dues ramp up. We've seen others in the state begin to experience some problems. So we've moved up our Q factors here in the fourth quarter, and we'll likely do so again here in the first quarter of this year. So again, just trying to give you more information to help better either understand and or justify changes to your Q factors.
Yeah, absolutely. And so we had one question come in, which we appreciate. But again, at any time, this is supposed to be an open forum for you guys to ask questions. So you don't have to wait your turn. If you've got a question, it doesn't have to be about what we're talking about right now. Any question you have about CECL or CECL Solver, feel free to throw in the Q&A there, and we'll jump on it right away. See,
And Steve,
now we got
and
one.
Steve,
Look at
with that,
that.
you just got one.
Ask and you shall receive.
All right. The question is going through an exam currently. When it came to CECL discussion, they had questions on Q factors and where our thoughts were. Thank you for providing additional details. Seem pleased that you all have coffee talks on a regular basis. These things matter. Thank you. All right. So appreciate that, JJ. Again, but I think that's really what we recognize, right? Is that the Q factors are critical. As we've said, over the years, your examiners want to understand, kind of where you are and where you're coming from and what you're thinking about. And so again, if we can provide, additional data to assist in that, then that's what we're trying to do. There's another question came in. Did you create a separate Q factor for peer adjustment?
Yes, that's the first, I believe that's the first one on the Q factors tab in the
Yeah.
CECL solver tool. The first column shows your historical lifetime loss rate, and then it goes into each individual Q factor or suggested Q factor in a column. And the first one is an adjustment for peer experience, and then the next one is for the other economic external factors. And this brings up a good point, and it's something I was discussing with a user just the other day, that those the list of Q factor adjustments that we have on our Q factor tab are suggestions, right? You do not need to make an adjustment for each of those different qualitative factors. In fact, the list is suggested things that you should at least consider. And that comes directly from guidance, and it's not CECL related guidance. That's interagency guidance from back in the mid 2000s or so, before CECL was even a twinkle in our eye at that time. But it was an interagency policy statement on loan losses and allowances, and it discussed all those different things that should at least be considered. So if you haven't had any change in your lending staff in 25 years, you certainly don't need to make a Q factor adjustment for changes in management and staff. So you can leave them all to zero, or you can actually, there's a little red trash can next to each column. You can actually completely remove the Q factors that are just not relevant to you guys, so it doesn't even come up as something to discuss on an exam or an audit.
Yep. All right. So move the slides on the industry trends. And so again, Steve, just some regional differences, or if you want to speak to some of the regional differences
Yeah.
we see.
I'm always, now that we have more interactive tools for looking at these industry trends over time, I get to use them myself internally as well, which makes some of these analyses that we do here for the coffee talks even richer. This is one that we've been doing for a few quarters now. We were just kind of curious about the geographic differences between things like reserves and non-performers. And we find that reserve levels continue to slightly decline. If you look at all the trends on the right side of that chart there, there's a relatively wide swath of reserve levels between the West Coast banks and Northeast being an outlier with significantly lower reserves in the Northeast, and that's been the case since the last credit cycle. Where the Northeast had significantly less losses than other parts of the country, and so they've had lower reserves ever since that time as a whole. But we see, in general, we've seen a slight continuing decreasing trend in reserves overall for community banks around the country, and that's been kind of consistent. One basis point a quarter, plus or minus, all the way back to when CECL first became the law of the land 3 years ago now. Everyone ramped up their reserves because the expectation was, with under CECL, everyone would have to, and I think everyone felt the pressure. So you saw a jump in reserves in the fourth quarter of 2022 and the first quarter of 2023, right when we were implementing CECL. And I think we've all slowly realized that we overshot a little bit, and reserve levels have continued to very consistently but very modestly trickle their way back down to just under 1.2% since the first quarter of 2023, which is interesting. But again, Northeast significantly lagging the rest of the country there.
A couple of questions. Yep.
Yeah.
I want to see what questions came in. The first one was a question from Brian about third-party model validations. There's a couple of ways to address this. He's a $500 million bank that used the WARM method. the companies they've reached out to tell them they don't see the value in doing one for us, as it would cost $20,000 to $30,000. Any thoughts on how we could address this? So one, there's a couple of thoughts. One, I don't know if you've talked to Saltmarsh. They're familiar with our tool. Paul Allen has been on our coffee talks a number of times. I don't think they're in that range, but perhaps they are. But you could reach out to them. Gary Young is formerly of Young and Associates. He was the founder of that company. Gary still does some consulting. He's a friend of mine. We're on a bank board together. He's familiar with the CECL solver, and I know his fee would be much less than that as well. And then thirdly, we do have the Excel tool that, if you, again, given the size of your bank, if you have someone who's outside the CECL process but could run this Excel version of it, you can use that to internally validate the numbers as well. And Steve, you may want to talk just a little bit more about that.
Yeah, well, that's so we found, unfortunately, that's been more of an uphill battle for institutions. Even smaller institutions are being pressured to use external third-party validation services for CECL. But from how we understood the regulations, it doesn't the validation does not technically have to be from an external third-party vendor. It has to be someone who is knowledgeable about the process and the calculations and how reserves are calculated and how all the math works, but completely independent of that function within the bank, which the smaller the bank, obviously the less likely you are to have analysts floating around who are totally unrelated to the to the reserve calculation, yet totally knowledgeable about it. So I think it presents a pragmatic challenge, a practical challenge, but we do provide some tools that can help, and and that can help if you want to do it, or at least partially internally. That might maybe bring that cost down, and you can decrease the scope of the external validation if you have some more internal tools that we can provide. So please reach out to us if you need more data or more help on that, for sure.
And JJ, just thank you for offering that, JJ. He just put a comment in the chat that they used Saltmarsh in August of 2025, and it was less costly. So thank you for sharing that. The other question we had came in is our opinion on using AI in justifying Q factors, and what is the current and projected economic environment in the metro area for non-owner occupied 1 to 4 family rentals. So, again, I think we're going to see more of it. I think, as always, we have to couch it. You have to give it kind of a sanity test just to make sure it's not it seems relevant. But I think it'll probably become increasingly a source. I don't know that I'd want to completely rely on it, but I think just no different than gathering more information to better understand. I think it's certainly a resource that you should investigate. Steve, your thoughts?
Yeah, I'm neck deep in this stuff right now, and just so you guys know, the robots are coming for all of us. It's just a matter of time. But seriously though, it's the way I look at those tools for doing research for things like qualitative factor adjustments and everything else. It's just like a Google search. If you were to search for something like that on Google, you'll get links to the FDIC. You'll get links to third-party institutions who have written about this or done presentations about this. You'll get industry data, direct first-party industry data when you do a Google search for something like that. Doing an AI search for it is the same thing. It's just one step removed from that, right? The answer you get is not the source, like where you have to click on the source and you see the primary data right there. The answer is, it seems like somebody talking to you, but the data that they're giving you, that they're talking to you about, is still sourced. So just make sure that whatever AI tool that you're using, there are options to provide sourcing at the end of every single question or response that you get, and how detailed the sourcing is. And I would just ramp that knob up if you can find that in the settings for whichever source AI, whether you're using the Chrome browser and you're using Google Chrome's one, or if you're using a ChatGPT separate subscription that you have for that, or Gemini, or whatever it is. What I found, it is scary good and pretty accurate at answering those questions. But like anything else, you're going to go, find that data from what it gives you, then follow it to the source right there, which you can do, and then double check it with the source. So again, it's one step further removed, but it typically does a very good job in that. So I've got um, yeah, I got no problem in using it. I think it's a tool that people should definitely be using, just knowing what the limitations are and double checking its work every time.
Yeah, and we've tried it. Again, we've begun using it again at our bank just right now on a preliminary basis, just to see how it compares to when we do what we would have traditionally done with our Q factors, and see how it compares, right? And so I think that's we're kind of, I would say we're using it in parallel right now, just on an informative basis to see, in fact, does it seem to be in sync with what our own kind of views of our area are as well. So
Yeah,
start with
I
something
don't.
with
Yeah,
something you can sanity test.
yeah. I mean, I don't see it replacing, the role of the research analyst right now, but it can make what they do, and if that's part of your job, much more efficient, right? You still need the right knowledgeable person who understands what's coming out of it to read it and double check it, but it can vastly accelerate the time it takes you to do some of that initial research.
Exactly. All right, Steve, I move the next slide just to some emerging trends that you may want
Yeah,
to
so
share.
we looked at on the previous slide, what was the we saw that the reserve levels were yeah, higher on the West Coast and much lower on the in the Northeast. And if we head to the next slide, we see interestingly that when we look at non-performing loans, the highest non-performing loans are in the Northeast, and the low, some of the lower ones are in the Midwest and the West Coast. So we find that at least recently, the Northeastern banks have had lower reserves and higher non-performing loans, and vice versa on the West Coast. So that's an interesting dichotomy there.
Yeah, and
But non-performing
I
loans
think
are still. Go ahead.
no, I was just going to say, I think what can happen when you've had a benign period, right? Like you can get a little bit of creep on it, right? That it happens fast, and if you've just been kind of maintaining your reserve, and then all of a sudden it pops up, you can get behind fast.
Yeah, and then there's a significant difference between, when we look at non-performing loans, right? They're further that it's more of a lagging indicator, obviously, compared to past due loans. When we say past due, we mean 30 to 89 days past due that are not yet considered non-performing. Non-performing being 90 plus days and still accruing, which is somewhat less frequently used these days, and non-accrual loans. So we see the trend of non-performing loans has been steadily creeping up for a few years now, with the Northeast kind of leading the way to a slight extent. On the next
Yeah,
slide, we see we look further further upstream to 30 to 89 days past due. What we find is interesting here is Northeastern banks don't have the highest past due loans. So while their past due loans are equal to or slightly below some other regions in the country, they're converting more right now to actually being non-performing loans. But what you don't see here is as much of a clear continued upward trend. Now, there's always a little bit more cyclicality in the 30 to 89 days past due. You see numbers typically jump up some in fourth quarters and first quarters, and then come down. Or go back up there for a second.
Oh, did I move it?
Yeah, you did. That's all right.
Oh, sorry. Oops.
Oh,
There we
there
go.
we go. Yeah. But what we saw here was a pretty large spike at the beginning of last year, in the first quarter of last year, in past due loans, and then it came down significantly in the middle, towards the middle of the year. So while the trend in non-performing loans and net charge-offs is still clearly trending upwards, the further upstream we look, we've seen, in my opinion, a little bit of relief when it comes to past due loans across the industry over the last year. So obviously they went up from the second quarter to the third quarter to the fourth quarter, but still down from the beginning of the year and even from the end of the previous year. So interesting trend there.
Uh,
So
Another
yeah,
question came in, Steve, regarding the unfunded commitments portions of the
sure.
report. Can you share which method you are seeing banks rely on more and why? This was brought up during our last exam.
Yeah, so this is probably something I should I hate messing with the screens, but should I share my screen? Should we risk it?
Sure.
All right. I'll go ahead and do that. Send request.
Oh, let me get there. That's my fault.
It's all right.
There we go. There we go. I'm stop sharing.
All right. Okay, I gotta move this thing out of the way. Move this thing out. All right. All right. Let me head over here, head to the CECL. So the question I assume is in regards to in the unfunded commitments, we had kind of a default methodology that we've had for since we started with the CECL solver. But last year we introduced a what we call a simplified method. I was always of the opinion that the default method was relatively straightforward, and we kind of anticipated that if we needed to come up with a update our methodology as expectations evolved from the accounting industry and from from the regulatory bodies, that we'd have to come up with something kind of more granular and more sophisticated and more advanced. But we found the opposite was true, was that they were looking for something that was even simpler to get their arms around and more straightforward mathematically speaking. So we created a simplified method, which just takes a couple of the little steps out of there and keeps it all very, very, very straightforward. So you have, a total unfunded commitment. You back out anything unconditionally cancelable. You end up with a net amount. That the net amount is what you have to deal with from a CECL perspective, from a reserve perspective. And then we have a probability of funding, which is the same concept as it is in the default method. And then we apply that to, so we do the math right there. We take the net unfunded commitment, multiply it by the probability of funding, and that gives us right there the estimated total amount to be that could be funded. So now we've already converted the unfunded commitment to actual potential loans. In the future, that we need to then apply a potential a loss rate to that amount that we expect might get funded. So looking at this screen here, 433 million in unfunded HELOCs, 36% probability of funding. So that this bank has an expectation that about 155 million of that might actually become loans. And of that 100, so then we simply apply a lifetime expected loss rate that is derived directly from the funded portfolio, right? And so we take that, obviously, well, let me give something that's not negative here. There we go. So let's say that's the unfunded commitment buckets, so to speak. These different buckets, some of them match up to the RC schedule RCC, your loan portfolio very, very well, like the HELOCs. Some of them do not. As you can see, there's obviously a lot more buckets here, but the HELOCs do. So let's say we're looking at the 1 to 4 family revolving. These are the funded version of those HELOCs, right? If you have 96 basis point expected future loss rate on the actual loans, headed to the unfunded commitments. If of your 400 million of unfunded commitments, you expect to maybe end up with 155 million of loans from those, and that same exact 96 basis point lifetime expected future loss rate that you have for your funded portfolio, you apply to the unfunded amount that you expect to become loans, and you end up with a reserve amount. So that's about as straightforward mathematically as you can get. And whereas the default method is a little bit more complex and kind of splits it back into years and then back into lifetime. So I think this is more straightforward. It's easier for a lot of the examiners to get their arms around. And so I would say that if I was seeing a preference, the preference would be the simplified method. It just has less questions and less subjectivity to it. It does tend to result in slightly higher reserves for the unfunded commitments when you use a simplified method. And while that certainly I can see why that could be concerning to people, it's think of that as simply front loading your reserve, right? If you expect these to get funded to at a certain level, you're only reserving to the amount that you expect to get funded. So if you reserve it on the front end when it's an unfunded commitment in the liability side of the balance sheet, then when it does get funded, you transfer that reserve you've already established to the ACL on the contra asset account on the asset side of the balance sheet. And so you pretty much just look at it as front loading or more being more aggressively forward thinking about the reserve on the unfunded commitments. So yes, it might be a slight bump in the one-time reserve there, but it'll pay dividends when those loans are actually funded. So yeah, we have seen a preference, I think, for the simplified method. So if you're considering moving over to it from the default method, I'd encourage you to give it a shot. John?
Yeah, and I would say to Steve's point, the challenge really was be just explaining it. So if you're good with it, then you should be fine. So
Yeah, if you feel like you can explain this or conceptualize it a little better yourself so that you have a more clear, discussion with it with your auditor, that's reason enough right there to make the change.
yeah. All right, Steve, can you see my screen?
I gotta stop sharing.
Yeah.
Now I can see, yes, I can see your screen again. Let me move all my things out of the way so I can.
All right. All right. Okay, so continuing into the credit quality.
Yeah, I know we're starting to run out of time here, but I wanted to just show a little bit more analysis on on past due loans. So we looked at from a regional perspective, right? And now we just kind of want to dig into some individual segments of the portfolio. So for the next couple slides, this is going to be on the left-hand side is going to be a long-term view where we see 10 years of that trend at the median and at the 75th percentile. And the chart on the right is the last couple years. And so this kind of is another a fun little exercise where you can see the trend that you might see on a long-term basis that's in annual chunks is not going to give you the granularity to get a feel for what's happening right now and what direction things are going in currently. This one actually does. This is 1 to 4 family past due loans, and you can see they dropped way down from where they were back in 2000, was it 2009 2010 where they peaked, came all the way down to 2011, and they have been creeping up for 4 years now. But like I said a few minutes ago, we have seen it kind of level off to an extent, and so you can see whereas the median or 50th percentile, that blue line, still did increase a little bit in 2025. The 75th percentile past due rate actually decreased slightly in 2025. And when we zoom in on the last couple of years on the right hand side there, we can see a little bit of that seasonality, right, to the trend. But we do see that the fourth quarter of last year was not significantly higher than the fourth quarter of the year before, if we're comparing quarter to same quarter in the previous year. So in some segments of the portfolio, I'm definitely seeing a decrease in the rate of increase of from a past due standpoint. Let's take a look at construction and land development. A definite indicator towards a cooling off of the increase. We had seen a more significant. Oh, just lost your presentation there.
You have it? Do you see it?
No, I just see your background now.
Oh, all right. Let's hold on here. Let me see what happened here.
Oh, it's back.
Okay.
There we go. So we see here in construction and land development loans, the same bottom, but then a very significant increase in 2024, but then a decline in 2025. And when we zoom in again on the right on the last couple years on a quarterly basis, we see that there was a 3-quarter peak and then a significant drop in the third quarter of last year, and then a little bit of a rebound in the fourth quarter, but definitely a leveling off of past dues from a construction and land development standpoint. And on the next,
Steve, yeah, we did have
yeah.
a question come in. With historical rate losses low and not wanting to be overly aggressive on Q factors, what have you been hearing from examiners on being overfunded?
Well, we we don't hear the term overfunded very often. Oh, just lost the presentation again there. There, now
Oh,
it's back. That's very weird.
that is weird.
We don't hear the term overfunded very often these days. We used to hear it a lot back in 2004, 5, and 6 when they were trying to argue that everyone was manipulating their earnings by overfunding loan loss reserves. We don't have very many of those discussions since the last credit cycle. But what we do see is a combination. Some institutions that have gotten very comfortable. A lot of these discussions are not conceptually any different than they were before CECL, right? If you didn't have any losses a few years ago and you still don't have any losses now, CECL didn't change the fact that your entire reserve was going to be justified through Q factors, right? And if you've had that conversation, you've been having it for years with your examiners and your auditors, and they've been comfortable with the Q, with your totally Q factor defined reserves. There's no reason you would necessarily have to change it. So we see a lot of institutions that just have zero historical losses. They don't get aggressive on the historical assumptions, and they just deal with all of it in Q factors. But we do have a lot of institutions who have tried to go or have been starting to go the other way, where they're being more aggressive with their historical assumptions, with the knobs they can turn historically. So instead of looking at a 3 or 4 or 5 year look back period where everything's been all rosy and zeros, they're going back and including some of the last credit cycle back in 2009, 10, 11, or 12 into the look back period, just so they can realize some historical losses in the model, so that the Q factors don't have such a high burden of the entire reserve coming from that. And I don't see one as necessarily being any more justifiable or better than the other approach. It's just how the discussion goes, right? How you take that and build it into a narrative of being more long-term looking in your historical. Therefore, Q factors play less of a role versus the other way around. So I haven't seen one really definite trend or the other on that. Sean?
We got another came through the chat here, Steve. Let me pull this up here. Is it fair to say CECL backtesting means comparing prior estimates to later actual performance, while recognizing that differences do not necessarily mean the estimate was wrong, because forecasts and Q factors are judgmental? Yeah, the short answer, Stephen, is yes. I've had examiners ask about back testing, but I'm curious what others are doing in this area. Yeah, I think
Yeah.
what you want to make sure the model performed as intended is what you're trying to square
Yeah.
up.
Yeah, back testing is not about showing that your math was correct. It's really about allowing you to stress test your assumptions, right? If you were way off, so to speak, after doing some back testing, which is you go back and look at a year and a half ago, right? And then you see what losses you've had, what the reserve, how you expected to experience losses over the next year, a year ago, and then look at how you did experience losses in that interim 1 year period, and how did it match up with the expectation that you had for losses. Now, take all this with a grain of salt, because if you have zero losses historically and you got a 1.2% Q factor adjustment, and then you haven't had and you're continuing to experience no losses, but you still have to have that 1.2% reserve, our back testing is going to continually keep suggesting that we're overfunded, because we're not seeing the losses that our reserve is expecting us to see incrementally, just the way the methodology works, right? For the same reason you need those Q factors. And so back testing is about giving you the opportunity to see, how far off you were and what that meant. Does that mean that an assumption you made on a Q factor or something has to change? And so it's really about back testing the validity of your basic conceptual assumptions about the tool, not about whether the math was technically correct or whatnot. And you're right, all those Q factors, they're subjective. They're how are current and future conditions expected to be different from the past. If we all knew what that was going to be, none of us would be on this call right now. We'd be on a beach somewhere with a very large account. And so, yeah, I expect back testing is going to continually show most of us are over reserved from a back testing standpoint. But that's just part of the how the process works. Sean, any more
Yeah, so a couple other
light?
things came in, and thank you, Jennifer, and for some feedback. Jennifer does a rate volume variance on the differences and explains large differences. We had another question come in or comment. We've been heavily criticized for being overfunded. The regulators want us to eat up the overfunded portion with the Q factors. And then there was a question if we have any back testing templates. And so we don't have any templates, but our Excel tool is probably the closest thing that we would have to
Yeah, and if you want to reach out, there's some, I can make some suggestions on some ways to take, a specific CECL solver scenario and do a little bit of math so that you can do some basic back testing on there, right? If you have a warm of 3 years and an expected future loss rate of, let's say, 1%, and then you're comparing your back testing from 1 year ago, you take that 3 year expected loss rate divided by 3, you get 1 year's worth of your expected future loss, and you compare that 1 year's worth to your net charge-off ratio over the last year, right? So you make sure the durations are the same for back testing or apples to apples, and then you can effectively do a back test. But for the majority of institutions, the back testing right now is going to show that your expectation of loss was higher than your actual loss, unless everyone is now, suddenly having 25, 30 basis points in charge-offs every year going forward, which most of us are not seeing yet.
Yeah, exactly. Okay. All right. So let's.
All right. Yeah, we're just about out of time here, but
Yeah.
I'll just kind of very quickly cycle through the last couple ones. Same concept that I've done and you can look at these slides at your leisure, but wanted to give that long-term trend and that recent trend in past due loans for a couple other segments of the portfolio. So when we look at non-farm, non-residential, again, we had a low 4 years ago, and it's significantly been increasing since then. We saw additional increase in 2025. This is one where even when you look at the last 8 quarters or the last 2 years on the right hand side, yeah, there was one. The first quarter of last year was a big spike, and then it came back down. But now we're kind of back into a continuing to increase trend. So I haven't seen quite as much leveling off, I would say, on the non-farm, non-residential side in past due loans as I have in let's say construction loans. C&I, a tale of two graphs, right? You look on the left-hand side, you see, all right, it's been increasing for 5 years, and it was still increasing up until the end of last year. Then you look on the right-hand side, and you see we had a significant peak early last year, and it's come down, I would say, significantly, measurably, over the last couple quarters. And then last but not least, I just wanted to do a little bit of size variation, taking a look at bigger community banks versus smaller community banks. And we see when it comes to past due loans, smaller community banks, the light blue on top are under 100 million, and then 100 to 500 million is dark blue. 500 million to $1 billion is green, and the largest community banks over $1 billion are the orange on the bottom. And they're nicely stacked, where there was a very significant spread between much higher past dues at smaller community banks than at larger community banks back in the day. Those all got very crunched up and much closer together by 2021, COVID. And then since then, that there's been a re-expansion of that differential between past dues at smaller banks being higher than at larger banks. Interestingly, the next slide and the final one, and I'll let everybody go. That doesn't track all the way through the asset quality cycle. Total non-performing loans, right? After After the next thing after 30 to 89 days is it starts becoming non-performing as it works its way through the process. And you can see here that that orange line, the largest community banks have the highest level of non-performing loans, whereas smaller community banks have slightly less. So maybe it's difference in how they're booking them and how they're managing them on the balance sheet. But if you just were to look at past due loans, you would assume that the smallest community banks have much worse asset quality than the larger ones, and simply not the case.
So Steve, we do have a few more questions that have come in.
Excellent.
If your back testing is lower than actual, what is the appropriate change to the assumptions?
Not necessarily anything in my opinion. Because I mean, if you're back testing, if you're thinking about it, if you had if you have very low recent historical losses and your reserve is made up mostly of your Q factors. I keep harping on that because it's such a common use case right now in our industry. If the last couple quarters haven't, you haven't seen any net charge-offs, then obviously it's the back testing is it's going to suggest that you vastly overestimated your potential future losses. But since the potential future losses are directly tied to your reserve, unless they expect everyone to start decimating their reserve when they're not accumulating losses in line with that, this is where there's
This is where there's
some
tension. This
cognitive
is where there's
dissonance
always
here
been
in the
tension.
industry.
Yeah.
The regulators want you. They after all the hoopla of CECL and everything else. I don't know if you guys remember about 6 months ago or so, we did a coffee talk and we analyzed the long-term impact of the change in accounting standard when it comes to real reserves at real community banks. And the TLDR, the long and short of it is, it didn't end up making a hill of beans of difference. We've been at about just below 1.25 as an industry 20 years ago, and guess where we are now? Within a 5 basis points of 1.25. So they're having a problem deciding exactly what it is that they want. If they want us to back test and then adjust strictly based on that back test, our industry is going to have a 40 basis point loan loss reserve,
Right.
and they're not
Exactly.
going to accept that. So if they want you to be strict about your back testing, then the follow-up question is, I assume you're going to be cool with me having my reserve when I do that. And we
Yes.
all know that, no matter what the math shows, they're not going to be cool with that. So we're all playing the same game we always have with just this very slightly different set of rules.
Yeah,
I wish I had a better answer for that.
but that's the truth. The next question is it possible to create slides similar to these within Quick Analytics?
Everything you see here is something that I can show you how to do in 5 minutes on Quick Analytics that you already have access to. Yes.
Yeah.
On the
Excel
industry
editors.
trends tab, you go to the main website before you go to CECL Solver. On the left-hand side, you'll see industry trends. You click on or industry research. You click on that, and then you can see exactly what you're looking at on the screen right now. You create the peer groups, choose the metric, choose whatever duration you want, and it dynamically shows up on the screen.
Sounds like we have a topic for the next webinar. And then, yes, Matthew, the question is, will this slide deck be available? Yes, you can look for it in an email on Monday. Okay, let's see.
All right.
So, so just some reminders, really what we've kind of built all the data on. Again, just these are recaps on all the different sources of information that we use to compile. Appreciate, obviously, all the questions today. Certainly thrilled with the attendance today. Appreciate that. Reminder, all of our past webinars, can be found on the YouTube channel. So if there's anything you want to go back and look for, certainly please do that. We do continue to offer a 3-month free trial. We had a question about getting more granular data or in some of the polling questions. Optima FI's portfolio analysis tool is a tremendous way to drill down deeper into your loan portfolio and get a much more granular look very, very easily. So we'd welcome to, give you the opportunity to trial it for 3 months and see if it can be of help to you. Steve's going to be on a webinar here next week with David Ruffin to talk about stress testing. So, certainly register for that, as if you register for all Optima FI webinars, you will always receive a link to the recording and a copy of the of the slides.
So you see how those polling questions were foreshadowing my webinar I'm doing next week with David Ruffin. So looking forward to that.
So again, thank you all very much. Let me give it one last look to see if we have any final questions. I don't think we do. So thrilled to be back. Appreciate everyone showing up here on Friday. Steve, great job as always. Jen, thanks for the technical help with me this morning. But appreciate it, and certainly hope you all have a great weekend. Have a happy St. Patrick's Day next weekend, and we'll certainly, Steve, will talk to you soon here on an upcoming CECL webinar.
Excellent. Thanks, everyone. Thank you, Sean.
Great
Thank
day.
you both.
Thanks. See ya.
Bye-bye.